Hi guys, welcome back to Marant's Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. So I'm going to break something down for you tonight. I've been putting this together for a while. I'm going to explain the true value of a company and how you actually extract that value. Now, people give you all the reasons in the world to invest. They'll be like, hey, here's the projected earnings, here's the earnings per share, and all these metrics that you want to measure a company on. But I'm going to show you my formula, how I actually measure a company. And we'll go from there, okay? So this is a PowerPoint presentation. Obviously, it's called GME. It's a buy, which it always is for me. And I'm going to explain the difference between what some would consider blue chips. Then there's, of course, growth stocks and value stocks. And then there's meme stocks, right? So the blue chips are pretty easy. It's all the big names that you see out there, the FANG stocks. And we're going to go over all of that in a minute. But in addition to that, I have to think about GameStop being listed as a meme stock. And it kills me every time because the value of this company is not being told correctly. And I'm prepared to change that right now. So let's look at the equation. So here's the equation. I hope it makes sense. This is called, and I should take myself off the screen here so you can see it. Okay, shareholder equity formula. So now on every balance sheet at the very end, at the bottom, it'll say shareholder equity and or shareholder deficit, depending on what the company is. Is it upside down? Is there any formula there? So what it is it's assets minus the liabilities. That equals equity. Now you divide that by the float, and that's equity per share. Now you take the price per share, you divide that by the equity per share, and you get net equity per share. Now why does that matter? Because the metric means that for every share I buy, how much of the equity am I actually purchasing? You see, you get a discount per share when you're buying bigger portions of the equity. That means there's better value for you. And so if the company does start falling backwards, they start selling off, they start diluting, whatever it may be, there's so much shareholder equity that you can dilute from, and that gives you value per share. So I want you guys to do the math, and I did it for you. So pay attention, please. And here we go. So here's the math. Now, I took all the big boys, okay? I wanted to give you an example of what we're looking at. Every time you buy a share of Apple, to give you an example, you're buying 2% of the shareholder equity per share because they have net equity of $62 billion. They have 15 billion shares. The share price per share is $192. You divide that by the 2 at the top, okay, the actual net equity in the shares, and that's going to get you to $3.95. So for every share of Apple, $3.95 is the net equity position. That equates to 2%. Okay, so do you guys get the metrics now? Do you understand how this works? There's Microsoft. They're showing you that for every share, $26.18 is covered as net equity position, 7.5% of the share. NVIDIA, 2% of the equity is per share. Now you see it all the way down. Meta, 16%. Google, 16.5%. Netflix, 12%. Tesla, 5.9%. 9.4%. for Costco. Amazon's at 11%. Best Buy is at 15%. I was really surprised at that when I looked it up. And look at Home Depot, guys. Home Depot is hanging on by a thread. Now, why is that? Because all the liabilities in the world and with all the assets in the world, they're actually a break-even company. They're only positive about $362 million of net equity right now. That's not enough. If you actually think of the position that other companies might be in, $362 million is basically zero, certainly for this company. So what it tells you is there's some of those legacy companies out there that are functioning off of their reputation and off of what they have been doing for so long. And yes, they're a huge company, but if you're buying it right now, you're probably buying the top. You're probably buying where you don't want to because look at their equity per share. It's 36 cents per share, which equates to 0.0011 equity percent per share. Do you want to buy that? I mean, I'm just asking you. Some people do. Some people, they offset that position with what they would get via a dividend, and that's fine. It's taxable income, but you're looking at $325 a share, and how much of it is really net equity? It looks like it's going to be going in the opposite direction. That's the way I look at Home Depot. But Walmart, what a knockout stock. At 159.30, $29.42 per share is net equity. That is the shareholder equity, and that's phenomenal. Okay, all of these companies are great, and when I show you what meme stocks are doing versus what GameStop is doing, then you'll really understand why I'm here and why I'm talking about this. And I'll even go into this a little bit further before I reveal the GameStop position. The biggest thing is this. When you see these companies, all you think is blue chips. You think these guys are at the peak of their game, and they're not. A lot of them have room to grow. A lot of them have the equity within the stock to keep doing what they're doing. And I can see it from here. I think Apple's near the top, but it could keep going. Nvidia can keep going. But Home Depot, I'm a little skeptical on. But think about this. You're evaluating companies. Whenever you say earnings per share or what's the revenue this quarter, you're evaluating for the quarter right now. You are not evaluating that balance sheet for what's in the bank, for what they actually hold. What are the assets and how much are they actually worth? That's what this does for you, this formula. Now let's go look at GameStop. Right here is GameStop at the top. The net equity position for GameStop is $1.271 billion on 304 million shares. That comes out to $4.17 a share. Do you understand that they're at 18% equity? The cash position alone makes this stock that much more valuable. This is the buy of a lifetime right now. Considering no one cares, no one's paying attention, they have the strongest balance sheet that you could ever imagine when you measure it metric for metric with other companies, all the blue chips. Now, when I look at these two at the bottom, Bed Bath & Beyond, a meme stock, AMC, a meme stock, they're going to tell me those are short squeezes. That's the first thing they're going to tell me when it comes to mine. But remember what they are when you buy it per share. Look at, they have a net deficit. They don't have net equity. The net deficit is $2.8 billion on Bed Bath & Beyond, and it comes out to negative $3.78 per share, meaning you are buying into a negative 1,200% equity position. Everyone else is in the positives. This is a negative net position on equity. Additionally, AMC movie theaters, $2.59 billion net deficit with the 1.5 billion shares. That's APE and AMC theaters. I had to go ahead and do the market caps and do the conversion. It's at $3.10 today. And as you look at it, they are operating at a negative $1.71 net equity position. You are losing 55% towards the equity. That means you are paying off their debt every share you buy. This is the outcome. Now, what is the next spot that I want to show you guys? Why do I want to show you this? I want to show you what they call GameStop. GameStop is called a value stock. Without a doubt, it's a value stock, guys. Considering that the equity position per share is 18%, that means that cash on hand, assets versus liabilities. You ever heard the phrasing by Meet Kevin where he says GameStop doesn't pay their bills? Well, if they paid them all off, every single liability versus their asset, they're in a net positive position of 18% per share. One of the highest positions in the whole damn world. Only Walmart beats them. So when I look at this price target, it says a 1-year price target for GameStop is $13.10. If it ever got to there, you better unload my whole house, my cars, my life, my wife, my children. I'm telling you guys, $13.10 would put us at a net position of, I don't even know, if $4 versus that, you're looking at 30 to 40%. 30%. That is phenomenal. That is phenomenal to be there. I just showed you all the blue chips in the world can't even get to that number. And that's why I invest in growth and value versus hope. Yeah, I know we're early, guys, and this is the greatest thing ever. But the one thing that no one's talking about is this right here, this page. It says hidden assets. Okay, assets and hidden assets. Now, as you can see, it's blank. It's blank for a reason. Okay, I'm going to tell you guys something. The hidden assets and the assets of GameStop are you. You're the one thing that's not on the balance sheet. Everybody asks me every day, Marantz, what are you buying and why do you buy it? Tell me about GameStop. I can't tell you. I can't tell you. I can show you. I can show you that they have an 18% equity position per share, which is one of the highest on the whole damn stock market. Additionally, I can show you that these investors, myself included, we're not going anywhere. We're going to keep buying the value stock that it is. And it's a great growth stock when you think about where they might go, where they could go. Yes, they have an impeccable leadership team. They have emphatic shareholders. And then, of course, guys, the branding alone is worth what? What is GameStop worth today? What are they cashing on? The reputation of a great business. Me, I'll keep pushing it out to the masses to let you know exactly what it is. And I'll tell you what it is. It is a blue chip that stands toe-to-toe with all the companies I just showed you. GameStop Can't stop, won't stop, GameStop. Keep it short and sweet. I'll see you around, millionaires. Peace.